So last week, the US market soared right after Jerome Powell gave a speech last Wednesday, and he pretty much sort of confirms a 50 bips rate hike in the coming December 14 rate hike. And that also means investors are pricing in the fact that the Fed will start to reduce interest rate somewhere in Q2 next year when the interest rate reaches the terminal Fed funds rate of 5%. Whether or not that will come true, we have to wait and see what's the CPI and PCE data for the weeks or months to come. The 10 to 2 year yield curve retracted a little bit since a less hawkish Fed would translate to lower short-term interest rates, which means lower rates for the 2-year treasury yield. But make no mistake, we are still very deep into the negative territory, so let's not celebrate too early because yes, we are closing in on the possibility of a Fed pivot, but things can turn south really quickly, and the next thing you know, Jerome Powell could just shrug off that idea. The S&P GSCI index that tracks the commodity prices, it was down for the month of November, so that is definitely one of the good signs that we could see lower CPI data released on the 12th of December. But over on the oil prices, it rose up last week as China is slowly but surely easing their COVID restrictions. Plus, the US EIA announced that their crude oil stockpile dropped 12.6 million barrels, which is the biggest drop since June 2019. So when supply decreases while demand stays the same, you can expect for the oil prices to go back up, which is not good for inflation. And looking at the manufacturing PMI, Purchasing Managers Index, its November number came in at 49%, which is the first time it fell below the 15% mark since May 2020 after 29 consecutive months of growth. So that just shows how demand is being crushed now after the series of rate hikes again and again in this year, which is precisely what the Fed wants to see in order to support their decision to pivot. And surprisingly, for the month of November, the unemployment rate remained the same, so there is more room for the Fed to break the economy. Quick pause, you can support this channel for absolutely free by checking out Interactive Brokers in the pinned comment down below. Start trading with the most reputable and well-regulated broker that allows you to trade fractional shares in the US, for which many other brokers don't offer. And the best of all, their fee package is easily one of the cheapest among all other stockbrokers. Thank you so much. Okay, back to the video. So last week, we also received the second estimate of the US Q3 GDP, and it has been revised from the previous 2.6% to now 2.9%. And that means we are now firmly out of the technical recession if this trend continues. For now. So what happened? Well, the economic activities expanded last month. We see consumer spending up 1.7% from the previous 1.4%. Business investment up 5.1% from the previous 3.7%, which is always a good sign because that shows smart money are gaining back some confidence. However, for the residential investment, that fell 26.8%, which is understandable because of the jumbo rate hikes this year, and that hampered the housing market greatly in the US. So much so that over 1/3 of the real estate agents in the US cannot afford to pay their rent. Let that sink in. Exports also up 15.3% from the previous 14.4%, while import activity lowered by 7.3%. So when you have more exports than imports, that results in a positive gain in GDP. Now let's take a look at another key inflation indicator, the PCE, Personal Consumption Expenditure Index, which measures the amount of consumer spending in the US. The core PCE, which excludes food and energy components, was up 0.5% month-over-month in October, or 5% year-over-year, which is slightly below the 5.2% in September. And that shows that inflation is starting to ease a little bit, but it is still too high. And looking at this table, we saw that there is a surge in the personal income, where it increased 0.7% year-over-year in October compared to the 0.3 and 0.4% in the prior month. And that's mainly because there were an increase of compensation and government social benefits payout for people that lost their job, as well as a one-time refundable tax credits. So expect this number to fall back to its median of around 0.4% for the coming months. And why is this important, right? Well, if the personal income number inflates too much, then that means we have a wage inflation. So in this case, the number jumped to 0.7%. It's pretty much a one-off, so we can safely assume that this is not caused by an inflation in wages. And the same goes to the disposable personal income. It shot up to 0.7% for the same reasons I just mentioned to you. So once it falls back to its median of 0.3%, you can already see a trend here. 0.6%, 0.4, 0.3, and then more 0.3%. it's declining, right? So that tells us that the Americans have lesser and lesser disposable income to spend on goods left and right. So that will translate to a potential drop in spending in the coming quarters, which means lesser revenue and profits for businesses, which means a potential earnings recession in the making. And let's not forget, the average American savings has plummeted in 2022, and with interest rates remaining at a very high level, so much so that the 30-year fixed mortgage rate is well over 7%. It is only a matter of time before this breaks the economy, so a Fed pivot is very much in the making for the first half of 2023. I hope you are able to follow this. If not, rewind this section, because this will be a very important topic in the coming quarter. So upcoming important dates for this week, it will be a fairly muted week with only the non-manufacturing PMI data on Monday, as well as the producer price index PPI on Friday. And here's my takeaway from last week. Lower GSCI index and PCE data for October means we should see lower CPI print on the 12th of December, which means 50 bips rate hike more or less confirmed for December. I personally would continue remain cautious going into Q1 next year and not go all in, but I am definitely not just waiting to time the market, because remember, DCA works best in a bear market, and the last thing you want is to miss the bull run when the Fed starts to pivot and reduce interest rates. Alright, that's all for now. Thanks for watching. Have a great week ahead, and I'll see you in the next one.